Berkshire has invested in many companies with stock buyback programs. Recently, there's been a backlash against buybacks. What are your views on this subject?
Well, it's very politically correct to be against buybacks now. And they're going to incorporate it in the loan program. I mean, there's a lot of crazy things said on buybacks. Buybacks are so simple. I mean, it's a way of distributing cash to shareholders. And
welcome to The Market is Open. Hey, Josh, how's it going?
Not bad. So we just watched a good Buffett clip where he talked about buybacks. You wanted to talk about that?
Yeah, so let's first talk about, well, first of all, Buffett says that he doesn't seem to care, between buybacks and dividends, and that buybacks are okay because if it seemed like the logical thing to do at the time, if companies have excess cash, you give it back to shareholders. So the first thing I think we should discuss is, I guess, buybacks versus dividends and why politicians everybody seems to be bashing buybacks right now. The government seems to be blaming, all these companies who have been doing buybacks, I guess, recklessly. So, why is that?
Yeah, so it's funny. In the interview that we just watched, the first thing Buffett mentions is, I know it's politically correct. So he goes right at the heart of the issue. And the reason that politicians don't like it is because share buybacks sort of defer taxes. So when you do a dividend, everyone gets the money today. So let's say I pay $100 in dividends. And the tax rate is 20%. So that means everyone pays that 20% today. But when you have a buyback, not everyone is selling their stock. Let's say only 10% of people sell their stock. So only those 10% of people recognize capital gains, while the other people, the stock is higher and they don't have the capital gain right away. So that capital gain is deferred. The future tax is technically the same. So if everyone sold their stock on that day, the tax would all be the same. But these people usually don't sell their stock that day. So that is deferred. And in my opinion, that's why politicians don't like it, because, they lose out on about 90% of the tax revenue today, which is deferred, in the future. And they have an incentive to demonize buybacks. So I think that's one of the reasons why politicians demonize it. And politicians have a big voice. So when they demonize it, a lot of people are like, yeah, they're right. And I guess a lot of people, there are a lot of people that like higher taxes. They want the government to do more. So a lot of people are sympathetic to that cause too.
Yes, I agree. I think, yes, that is one reason why politicians don't like buybacks. But at the same time, I think a lot of politicians didn't really do that calculation in their head. I think Milton Friedman said that the government doesn't usually like to be blamed, and they try to find other people to blame. And in this case, they found companies that have been doing buybacks seem like a good place to start to sort of divert some of the attention away from the government and onto companies who have, been doing buybacks, but most of them seem legit, especially at the time when they did the buybacks.
Yeah, so I think you're right about that too, that there's also a correlation and not causation, that the companies, you're right, the politicians might not do the math, though there could be some sort of school of politicians where someone mentions it, hey, I hate buybacks, or politicians know they hate it because there's some sort of underlying reason, but no one necessarily knows the math. But what they might know is sort of the correlation is, hey, company A does big buyback, company A goes bankrupt, and the company is doing the math. They know the buyback is more tax advantageous. So if they're going to do a big sort of windfall money to shareholders, they're more likely going to do a buyback than a dividend, because if they do a dividend, they're going to have to pay all the taxes right away. And we've seen a lot of, I know you used to own a stock where they did a weird split off transaction just to avoid taxes. Yeah. So companies will go to great lengths to avoid paying taxes. And when this happens, a buyback is one way to avoid taxes. So when they're going to do a big sort of cash payment for shareholders, they're going to do a buyback, and this can sometimes get them into trouble. But if dividend and buybacks have the same taxes, they might have a big dividend one day. And I've seen it a few times, Domino's Pizza 8 years ago did a $15 dividend. We've seen it once in a while. There's, a massive dividend taking place. In that case, it might have been a liquidating dividend, so it might not have paid capital gains, but I'm sure there's been a situation in one time in history where a dividend has been a huge amount, and that company could have got into trouble.
Yeah. So when do you think people should be should be doing buybacks nowadays? Warren Buffett is saying, first of all, that they should be buying back shares below, if they think it's worth less than what it's trading at. He's saying that buying back shares at any price, which companies do, they do monthly, they have their share buybacks plan or quarterly, where they buy back shares. Do you think that still makes sense? To keep doing that, or is Buffett right and he's saying that it makes no sense to just buy every month?
Yeah, so in Buffett's point in the video, he said that, he's very shrewd. He's only going to buy back the stock when he thinks it's below intrinsic value. So what Buffett is sort of saying is he's calculating his intrinsic value and he's discounting Berkshire. So if the stock is implying that the return would be better to buy back the stock because the valuation of Berkshire is trading below that intrinsic value price, that means buying back stock would net you a higher return. So Buffett is saying, I'm only going to do that then. I'm only going to buy back stock at that point. But most companies, they just have excess cash. So if you're a clothing retailer and you make $900 million in profit, and you don't want to invest in 100 new clothing stores, you actually may even want to cut back your clothing stores. So what are you going to do with that profit? Are you going to pay a dividend where the government's going to tax you more, or are you going to do a buyback at any price? So I think buybacks for most companies make sense, even if the return is lower than what Buffett is saying, just because they have nowhere to put the money.
And do you think okay, so yeah, I'm thinking that the excess cash calculation might change a little bit because companies need to retain enough money to grow, is what Buffett says. Maybe they have a little bit of cash, but perhaps they have like a larger rainy day fund nowadays. Like you as a person may have a rainy day fund in case something happens. You might need to pay rent or something for an extra 3 months, 6 months, a year. But companies, I don't know if they're dropping after a month. We haven't seen very many bankruptcies. However, maybe they do need to have a rainy day fund, and we've seen that companies like GM and Ford, which struggled a lot during the recession, now they seem to have a ton of cash. They've been pulling cash, from many different places to raise cash because they know what's coming, and that's essentially their rainy day fund. And we're not even talking about bailouts for them. Whereas some other companies, if they do have excess cash, should they be paying it out right to shareholders, or should they be putting a little bit extra into this rainy day fund that they all might need to have, going forward just in case?
I don't know if it's correct though, because so I did a video recently on Warren Buffett. This didn't get into the video sort of early Buffett life, but one of the reasons why Buffett was so successful early in his career was all these stocks traded at super low valuations, and the reason is because all those companies had humongous rainy day funds from the Great Depression. And then Buffett and his friends just went around and broke up these companies and, extracted the cash out of the company. And it was very profitable in the 1960s because there was just basically every company had rainy day funds that were. So again, if we go to that video, like I show a lot of his early investments, he's breaking up companies with $100 of cash a share. And all the companies did that. And what are we going to do? Go back to that? So we just repeat history at that point, I guess.
Yeah, definitely have a look at our other Buffett videos on youtube.com/themarketisopen. So doesn't make sense nowadays to be buying companies that are holding so much cash. I guess that's the other side of the coin. Whereas you as an investor can just, you can hold as much cash as you like as excess cash in your portfolio. You don't need to buy a company that's 50% cash. Like, remember when Apple had so much cash on their balance sheet, people got mad at them because they wanted, shareholders wanted them to distribute that cash. And because Apple wasn't doing anything with it. We're looking at Berkshire. They have 137 billion in cash. Of course, Buffett can do whatever he wants with that cash, and he's known for making big purchases. But if you're holding there's a balance between holding too much cash and holding a rainy day fund that's large enough for a couple months just in case, before at least to not have to have the government step in all the time in certain industries.
Yeah. So do you mean sort of the airline industry right now, or?
Yeah. Well, yeah. Again, we've seen GM and Ford seems to be doing a lot better now than they did in 2008. They've changed their strategy. The airlines might need to change their strategy. Of course, they did actually, some of them do have excess cash, and a lot of them, I know American Airlines was buying back shares like crazy. And a lot of these managers are issuing debt in order to pay off shares. Maybe they should be paying off their debt first. But do you think also that's an incentive for managers to be doing these weird calculations these weird strategies where they don't really care. They're just buying back shares to prop up the stock price, where that might not be the best use of the cash at that time.
Yeah, it's hard to know. I think most businesses sort of, for whatever reason, GM and Ford are sort of an anomaly on why they keep so much cash. And even they right now are raising a lot of cash. So they kind of disrupt your point a little bit, or defeat your point, in the sense that they're raising as much debt and cash as any business, sort of thing.
Well, they have the ability to do that, but we're not talking about bailouts for them. Whereas, every airline needs a bailout. Suddenly, if they had wads of cash, or at least access to get a bunch of debt, then they'd be able to to survive this a little bit better.
Yeah, I mean, definitely, I think it shows that the airlines, most of them, didn't hold enough cash. And one metric you can look at is sort of current assets minus current liabilities. So airlines receive tickets up front. They sell tickets 4 months from now, and then they have that revenue. And then airlines, like Buffett likes businesses like that, but sometimes people don't even travel. But anyways, they get the money up front, and then they could pay that out in dividends. So most airlines, held a lot less. They would pay out that money before people actually flew. And then now that people aren't actually flying, a lot of that has to be paid out in refunds. And now suddenly a lot of them don't have enough cash. The Southwest tickets are 80% non-refundable, so they don't really have that issue. But anyways, I do think some of the airlines that don't have non-refundable ticket policies and have tickets that are fully refundable do sort of need to rethink that. So that's sort of a mistake that those managers made where they didn't consider that. But I think overall, the airline is sort of a unique industry, but it seems overall it's like, I guess we'd have to go case by case of which companies needed cash and which companies screwed up a bit. But overall, I'm not sure how much needs to change from, a 40% drop scenario. I consider this sort of the government's fault and something that, if we take proper precautions, we could prevent this in the future, or doesn't necessarily need to be something that's modeled if we know how to take precautions in the future.
Yeah. Anyway, yeah, one precaution could be as easy as just holding a little bit more cash than usual. Okay, yeah, so Buffett thinks that buybacks are okay. Check out our other Warren Buffett videos on our main channel. We'll put links in the description. Thank you guys so much for watching. Please hit the like button and subscribe to our channel.